by the end of next year. Bitcoin, 150,000. Wow. You're a wild woman. This is Marianne Bartels is here with Sanctuary Wealth. You are not afraid. You're fearless.
Well, that's
She's not afraid to take a stand,
After 40 years of being in the business, Joe, I've developed some confidence in the analysis that I'm able to do. And, you were right. You said that, we need growth and AI, and I think it's coming. I think it's going to significantly impact corporate earnings, productivity, and it's going to show up in the equity markets. And Joe, it's not just a bull market here. It's a bull market globally. You're seeing European markets break out. I think you're going to get the Japanese market to break out. It's a global secular bull market driven by all this new innovation, from AI to blockchain to crypto to Web3. And I don't think all of this is yet priced into the market. And you can see we're already in a summer melt-up. The market is not positioned for this yet.
That was something big just hit me. It was an asteroid. No, okay, here's the big thing that just hit me. I was just thinking about this because I was thinking about in terms of the market, and I was thinking about, you always got to think in regards to stock market. Is there a better alternative? Is there somewhere better to put money, right? We know treasuries, you can get 4% in treasuries if you want to be there. High yield savings account, you might be able to get something in the 3s. Even getting in the 4s is tough now at this point in time. And then I thought about one of the biggest money sucks away from the stock market is what? Real estate. Real estate. One of the biggest money sucks. Think about me, for instance, right? I got a new home being built. It's a very expensive home. So every few months, as the process goes along, I have to part with hundreds of thousands of dollars, right? Boom, boom, boom. Less money to go in the market. But think in the respect of no one's buying new homes. Home sales are dead. We've been for the past year or so. You could look at home sales numbers. It's like great financial crisis type volumes. No one is moving right now. It's hard to even if you got some nice furniture to sell and you want to list it, it's hard to even find people to buy it because no one's moving. Everybody's just staying put in the same apartment they live in or the same house they live in. Real estate investors aren't buying anything right now because they don't think there's a good ROI out there. So if you make money, your money starts to stack and it's not going into real estate, which is usually one of the biggest money sucks away from the stock market. So when the real estate market actually comes back, which, might still be several quarters from now or it might be a year or two from now, right? It's going to suck money out of the stock market because I see it all the time. I see private stock group members, regularly. I've been running the private stock group now for 6-7 years or whatever, right? I've seen plenty of times where somebody says, I got to sell, it hurts me to sell this stock I have, right? But I have to sell it because I need it for the down payment on the new house I just bought for my family, right? Or for myself. It happens all the time. Or they buy in a condo or something, or they buy in a real estate investment property. So they sell out of, a position they have or a bunch of stocks. And they have to sell 20% of the portfolio to cover the down payment on the new condo, the new house they got. I've seen that 1 trillion times in the private stock group, right? That happens on a regular basis, but that's when homes are moving. No one's moving right now. So then people's money stack and they're looking at it and they're like, what am I going to do with it? Stock market. That's where you get the ROI. Even this year with all the drama that's gone on, they were just showing it. The S&P 500 is up 7% this year. If you've been in a treasury this year, you know how much you've made so far? About 2%. So you could have been in a treasury making about 2%, or you could have been just in the S&P 500 made 7%. And then if you were in good stocks, you're up probably 30 to 50% so far this year, if you're in really good quality stocks. Versus 2% in treasury, versus about 1.5% in a high yield savings account. And real estate's a no factor right now. So someday people will want to buy real estate investment properties again. Someday people will want to move again. And people will start buying homes and condos, and there's going to be a lot of action. And that's going to suck money out of the stock market. But it's not today. It's not today. But it will eventually happen. But the stock market, there's no doubt, it's been a big beneficiary of this.
A point that was made by Kevin Warsh yesterday, I don't know if you saw it, Marianne, that there are powerful disinflationary forces coming from AI. And if you think about the internet, none of us had any idea what that was going to usher in. And if this is more powerful, what happens with AI than the internet, think about in terms of it maybe not just disinflation, but the amount of, I guess if you have growth, deficits, and debt becomes, less cumbersome, and therefore there could be perhaps a secular disinflationary trend from technology, which is pretty exciting. But we could have lower rates and not worry about it.
And I agree with that. I do think rates are trending down and can go much lower than people expect. Right now, we're in heightened fear that tariffs are going to bring inflation. And I think over time, especially trending into next year, we can get rates down. And that's going to be another stimulus for risk assets, for the equity market, for the crypto market. And then maybe finally we can get something moving in the housing market if we can get rates down.
Marianne, you didn't start the year at 7,000, did you?
I started the year at 7,200. And when tariffs hit...
Yeah, go ahead.
Another factor here that I think is important we address, right? We just talked about the housing market, is what is another big money suck away from the stock market? You know what it is? Anything that people buy that's like, I call it, I feel good about myself, I feel good about my financial situation purchase. You know what things like that come to mind? Boats, ATVs, jet skis, all that stuff. All those businesses have not been in the best place the last few years. We all know that, right? And, as somebody that knows people that run different business models like that, like those businesses have not been the business models to be in the last few years. They were really hot kind of during the Rona, right? And especially after the stimulus money. So like the back half of 2020 into 2021 and even the beginning of 2022, those businesses were hot. Then interest rates went up huge. Everybody got hit by inflation. Obviously, those business models have not been the best the past few years. But those are sorts of purchases that sucks money out of the stock market too, right? But people just haven't been making those sorts of purchases because they don't feel necessarily great about their financial situation. So they, like, you buy a freaking boat, dude, that's like one of the most confident, like, pump your chest like moves you can make. Like, you bought a freaking boat? Are you kidding me? You flipping my flapjacks here? You bought a boat? Like, you go buy some jet skis, you go buy some ATVs, some side-by-sides, whatever. Dude, that's like, you got to feel really good about yourself to be making those sorts of purchases. And those just haven't been the play the past few years, right? And so that's another thing that people say, you know what? I'm not buying a boat right now, but I'll go buy some stocks. So the thing that's interesting here is you could actually have, let's say the economy actually strengthens over the next few years, the housing market comes back, right? These sorts of purchases come back. That doesn't necessarily mean the stock market's going to boom. You can see the stock market kind of be blah, while the economy is actually, let's say strengthens a lot. The housing market strengthens a lot because money gets sucked out of, let's just call it, it gets sucked out of the market and goes into a lot of these things that are big ticket purchases. Like, how many people have been going out there to go spend $20,000 in new furniture? There just hasn't been a lot of that the past few years, right? Look at RH's numbers, and that's the high end. RH's numbers have been pathetic the last at least 2+ years now at this point in time. Pathetically bad. And they cater to the top 10% of income earners. They cater to the top 10% of the wealthy. And even when you cater to them, your numbers are still trash. So, that's the sort of economy we've been in, but people still stack money, and so they put it in the market. So it's going to be an interesting dynamic. I'm really looking forward to watching this next few years in the market because there's a potential that the gains in the S&P 500 and NASDAQ, 2026 through 2029, it's a potential they're going to be very limited. Now, there's going to be certain stocks that absolutely go beast mode, but there's a potential where the stock market, is kind of blah during that time. And there's a potential you actually have a much stronger economy, a much stronger housing market than you have right now. And people will look at the stock market and be like, it's not really reflecting. Remember, if you look at the stock market and the economy over the past few years, people have said, man, the stock market's doing amazing, but it doesn't feel like the economy's doing amazing. It feels like the economy's just kind of like blah. But yet, look at this freaking market. Like, you would think, based upon looking at the stock market, you would feel like this is the strongest, best, greatest economy in the history of the United States, right? Like it can't be beat. Like everybody's got to be feeling, the best they've ever felt. It doesn't feel like that. It feels like the economy's okay. Like that's just what the vibe is. Like the economy's okay, but it doesn't feel like the strongest economy, right? Like the two strongest economies, I would feel like a consensus. Like everybody felt like those economies were really strong. I think the economy we had prior to Rona for those few years, I think that felt really strong. Like there was a building of the economy. Then Trump came in with like the tax cuts and those sorts of things, some deregulation. It felt like that economy from kind of like, let's call it through 2017 through 2019, it felt like that was an overall very strong economy, right? And then the other economy that felt really strong was like 2021, but it felt actually too strong. But that was because, the reopening of things, so that re-energized businesses and business spend, and then you had the stimulus money and all that. So like that was artificially too strong, basically the 2021 economy, let's call that, right? But does the economy in 2025 feel like that? It doesn't. It feels okay. So it's going to be a fun next few years to watch how the market does versus how the actual economy does 2026, 2027, 2028. So
when tariffs hit, we did mark down that if we did go into a recession, those targets wouldn't be hit. But since after we went down 20% from the tariffs, we've been raising our targets ever since. And so I'm comfortable getting to year end at 7,000. And I think in the first quarter of next year, we might even be at 7,200. What I learned is that I shouldn't have changed my forecast.
Right.
The thing that could screw some people the worst is, let's say there's this consensus, like the economy really starts to improve 26, 27, like people start to feel great about the housing market, like spend, and it just feels like the average person just feels great. The average middle class person feels like inflation's under control, interest rates go lower, they feel like the jobs market's good, small business owners, get back to making, best profits they have in, long time. Let's say that happens. Like, I just wonder, I could see valuations on the market actually coming down. I could see that being a potential where the PE ratio looks like elevated on the market, but I could see it coming down because let's say less money's going into the stock market, right? And we have a dynamic where earnings keep increasing, then PE ratios will actually come down and come down considerably for the market. And so the market will actually look cheaper and cheaper as it goes along. But I could see some people getting screwed bad. And how I could see that is, let's say, a lot of people have been anti the stock market the last few years because they felt like the economy is not good or whatever, right? Or all the drama going on. Imagine people, because the economy starts to feel better, the housing market, all that, there's just more good vibes. Imagine people are buying heavy in 26, 27, 28, just the market in general, the S&P 500. And then imagine they hardly make any money over those next few years. And then imagine after that, you actually get a bad economy. Like there's a crash that happens. Let's say things get too good, like people take out way too much leverage, something like that. Like that would be fascinating, right? And then, man, a lot of people would be very jaded about that. That's all I'll say about that. And that's why you just got to stay invested. That goes back to the whole time in the market beats time in the market, because like you don't know how the market's going to react. You don't know how it's going to react, but you got to be in it, right? You got to take advantage of opportunities out there.
Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That is my personal advanced software that I use to make my investment decisions when I go to invest in companies. As somebody that's been in the market 15 years, I got sick and tired of using these different services that folks have out there that are designed for traders in the market. People that are looking to get in and out of stocks. That's not what I'm here to do. I'm here to long-term invest. I need to be able to see all the different ratios and metrics that are very important for me as a long-term investor to judge if I'm getting a great deal on a stock or if I'm getting ripped off on a stock. I need to be able to compare different companies versus each other and be able to do that in a matter of seconds rather than it taking hours like it used to before I created this service. I want the ability to listen to conference calls, see SEC filings all in one service. That is what we've created with 1000xstocks.com. If you are looking to access this software, go down to the description area of this video. You can click the link down there and apply for access. If you don't want to do that and you want to search a website, go to 1000xstocks.com. Enjoy it.
All right, let's get into Tom Lee.
Head of research Probably not coming as a big surprise to you, Tom. You've been saying similar things, but one of the things you're emphasizing today, the most hated V-shape bounce in history, or at least in your young, but getting older life.
Yes, that's right. I think many people, when April happened and we had Tariff Armageddon and the market went into a free fall, investors liquidated because they thought we were entering a recession. But, and as you guys had covered, like the market then staged a V-shaped recovery, which caught many people off guard because they wanted to have a chance to get in. They wanted the stock market to be like a K-shaped or flat line. Instead, it was a V-shaped bounce. And so most investors are underexposed at the moment, and they're trying to look at headlines with a half-empty view. But as you...
Let me let him finish, and then I got to get into a big point if you want to make a lot of money in the stock market.
Guys, no, earnings have actually been really resilient, and I think it tells a very good story.
Yeah, Dow's hasn't been.
Okay, so there's a huge mistake investors make. When something happens like what happened in April, right? A lot of investors think they know how the stock market's going to react after that. So they think it's going to be a slow recovery, or it's going to be this type of recovery or that recovery. You have no clue what type of recovery it's going to be from the stock market from there. If you're hoping it's going to be some slow recovery, it might be. And then, yeah, it might slowly go up over the next 6-12 months and come back. It might also be back in a month or two. And we've watched a lot of these V-shaped recoveries in the market. So how do you make the most money when you're in one of those markets? When you see the VIX go 30 plus, then push 40 plus into the 50 range, you buy hand over fist. When you see the NASDAQ go down well over 20% from recent highs, you buy hand over fist. You buy, and you buy, and you know what you do after that? You buy. And, if the market slowly recovers and it takes, 12 months, 2 years for it to get back to the previous highs, that's fine. That's fine. You're already buying the market in stocks if the NASDAQ's down 25%, you're getting likely 40 and 50% discounts on a lot of individual stocks. Right? Sweet. That's fine. Take a year, take 2 years to come back to the previous price. That's fine. It's still going to be a great return in the end. But you know what happens a lot of times? It comes back way faster than that. You'll see stocks bounce back in a matter of 1 to 2 months. 1 to 2 months. And so if a stock goes down 50%, how much does it have to go back to get back to that previous price? 100%. So a lot of these stocks go right back to their previous price in a matter of a month or two, which means you make 100% appreciation. And that's what we've seen from countless stocks. I could show you stocks I own personally that have climbed between 50% and 150% since an April bottom. 50% to 150% in a few months. It happens quick, really, really quick. And so that's how you maximize your amount of gains when you're in a market like that.
It has hit a new high, but it hasn't in the recent session. But S&P and NASDAQ continue to do pretty well. So there is also a perception, Tom, that valuations have returned to levels that have people worried. And you are citing an equity-weighted S&P multiple. Explain that.
Yes.
Of what? What's the equity-weighted multiple right now?
Yeah, what we're saying is instead of someone saying, oh, the MAG is making the market expensive, let's just take the average PE of the S&P of every stock. And it was around 17.6 times in 2019. Now we've had 6 what I call extinction-like events, COVID, the bullwhip supply chain effect, inflation surge, Fed fastest hikes, Trump tariffs, and then, of course, U.S. bombing Iran.
6 of them, yeah, okay.
Yeah, all of them should have wiped out earnings, but the S&P earnings have grown, and yet the equal weight PE is now 16 times. So the market's gotten cheaper in the last 6 years, despite proving they can grow earnings through 6 extinction-level events.
The Mag 7, though, there was a journal article that says there's a real split between the Mag 7, those that are really doing well from AI and those that aren't. And if you look at the stock performances, I think Apple's down something like 16 or 18% over the last year, while you have Microsoft and others that have really taken off. Do you think the Mag 7 stays together, or do we need a new terminology, a new grouping for leadership in the market?
But whoa, hold your horses for one flip and flapjack and moment here, okay? In regards to Apple, listen. Apple's underperformance is not just because they don't seem to have a good AI strategy and because they're not spending money on AI. That could be part of it, but let's not kid ourselves. Apple's business has not been very exciting the past few years. Like, look at Apple's numbers, look at their products. It doesn't really have anybody saying, oh, Apple's so exciting stock, such a exciting investment opportunity. It doesn't, and it trades rich. So that's why Apple's underperforming. Like, the AI component, that's a small part. Most of it just has to do with, like, people are not excited to go out there and upgrade their iPhones and iPads and Macs and all that sort of stuff right now. And so that's definitely holding Apple back. And when you got a higher valuation, it holds you back even more. So if you look, like, over the past 2 or 3 years, that's why Apple is so significantly underperforming stocks like Meta, or even stocks like Microsoft, stocks like Nvidia. That's a huge component of it.
I mean, to me, the Mag 7 have become household names. You know, like Apple is Apple and Google is Google, and we know the product and we know the stock. And I think they have really established themselves as consumer and business companies. And for me, Apple has been sort of quietly ready to pounce on AI, but I don't think they need to pay up for any of these models. So I think Apple is going to surprise people.
That's interesting. That's a contrarian viewpoint. People think Apple either is too far behind or just isn't going to be able to get the talent that it was. It's losing talent, not getting it.
Yeah. I mean, they didn't launch an iPhone until 2007, and mobile phones had been around for 15 years. But when they did enter that market, they completely transformed the marketplace. So to me, I think when they want to play big in AI...
That's just it's just such a bad take from a very intelligent gentleman like Tom Lee, but I'm seeing just so many people get wrapped like into this bad thought process around Apple. Oh, mobile phones were and then they came out with the iPhone. Look at how successful they were, right? Listen, man, where's Steve Jobs? Where's Johnny Ive? Steve Jobs and Johnny Ive are the reason the iPhone was a big thing. Steve Jobs and Johnny Ive were the reason the iPad was a big thing. Steve Jobs and Johnny Ive are the reason the MacBook was a big thing. Steve Jobs and Johnny Ive, those two gentlemen, the whole product suite that Apple has that's been their big money makers, all Steve Jobs and Johnny Ive. They're not around to pull the next rabbit out of the hat, to make the next huge successful thing. So to act like Apple's just going to come out with the next massive $1 trillion business without Steve Jobs and Johnny Ive, it's just not. Those are the two guys. If you really understand Apple deeply, you understand everything came from those two gentlemen. And neither one has anything. One's passed on, obviously, and the other one has nothing to do with Apple anymore. So you're screwed. Like they got their cash cow businesses, and they're just going to keep throwing off money, and they're going to ride those businesses as long as they can. And until the smartphone market's really disrupted, and tablets are really disrupted, and app stores are really disrupted, until that happens, Apple's going to make bank. And so someday that's going to happen, right? Someday we won't need smartphones anymore. Someday we won't need, MacBooks or iPads anymore. But when is that? I don't know. Maybe it's 5, 10, 15, 20, 30 years from now. Someday it will happen. And that's when Apple will actually face a crisis in their business, right? But that's a long time from now. And so, but to assume because Apple did successful stuff in the past, the two gentlemen have nothing to do with the company anymore. That made the whole business.
And when they do in that moment, I think they will change the game.
Well, so the question, though, is do you think that historically they've been able to do that because it's been a hardware game largely and a bit of software? I don't want to say.
Oh, this disgusts me. It's so disrespectful. It's so disrespectful. Steve Jobs and Johnny Ive. It's so disrespectful. This is unbelievable disrespect. Unbelievable levels of disrespect to Steve Jobs and Johnny Ive, what they're talking about right now. And assuming Apple can do all these big things, because it's Apple. Dude, no. It's Steve Jobs and Johnny Ive. Freaking, it's unbelievable.
Software's not a huge part of it. But the question is whether you think the LLMs have become so advanced that to get there, you actually have to buy somebody else to do it, or you can actually catch up? I mean, that's the fundamental question underneath all this.
Yeah, and it's also possible that LLMs all get so good that they are about the same.
Right.
And then Apple
gets commoditized. And
correct. And so then Apple comes in and says, look, we have our safety. Look, we're known for our safety rails, protecting your privacy, optimizing what you want to do, make your life better. And they might come out with a version that really, makes heads spin. So I think that I'm not ruling out Apple just because they're a little late.
what do you make, by the way, there's some speculation over the weekend, some reports about the first real Apple foldable phone this fall. Would you buy a foldable phone?
Yeah, I mean, I'm...
Big market in China, by the way. People in China seem to love foldable phones.
I think what I found is when you offer someone a bigger screen size, you're pushing them more towards computing and something much higher capability. And with AI, we might want some of that augmented kind of reality. So maybe the time is right for, a foldable phone. And again...
I'm sorry, we got a minute left after last week in the Genius Act. And you suddenly are, I don't know what...
Yeah, I mean, the name of the game for Apple is just keep, coming out with bigger phones, foldable phones. Do whatever you got to do. As long as the phone cycle's still here, Apple's good. Until the phone cycle breaks and we actually break away from smartphones, that's when Apple's going to have problems. But for now, change the form factor over time, make it a bigger screen, make it thinner, put 5 more cameras on it. Do whatever you can to just, keep trying to get some level of excitement around the phone.